Nela, we keep asking this question, but it is as relevant today as it was at the beginning or through the pandemic. Can this rally continue even as, consumer spending is questionable, the future of any new stimulus is questionable, employment figures are questionable?
Yes, the rally can continue, but because of the three reasons you mentioned, it won't be a smooth uptick higher. Smoothness is not in the forecast, volatility is. But if you think about what's driving this rally, it's really three crucial things. One is optimism about a vaccine. We've seen that. The second is lower for longer interest rates. The Fed just doubled down on that expectation last week. And the third, and this is the one where we may see some challenge here as we round out the year, is a quicker than normal recovery in terms of earnings. I think this is where the markets might be a little optimistic. This is a source of volatility, especially if we get a second wave of coronavirus outbreaks in the fall. So some uncertainty, but that theme of lower for longer interest rates, that remains regardless of the economic scenario, and that is helping push the stocks higher.
I was speaking a little bit earlier with somebody about the idea of a K-shaped recovery. Connor Sen has a great Bloomberg opinion piece out on that today. Is that the kind of thing we're going to see, though? Several of the larger companies doing fine, demand hanging in there because they're adapted to this kind of environment. And, really all of the other smaller companies, the less well off, just headed that way.
Wall Street has become Sesame Street, given all the letters we've seen come back and forth from V-shaped to W-shaped to K-shaped. Let's just say it's going to be an uneven recovery. This is like no recession that we've ever seen. It doesn't start with manufacturing. It didn't start with housing. It started with the service sector. And so that's where you're going to see companies, especially smaller companies that can't enjoy low interest rates in the capital markets. That's where you're going to see that struggle. You might see an uptick in bankruptcies and recovery rates that will weigh on companies in the latter part of the year. So there's still a lot of toll to work out, even as we march on slowly towards a recovery. And let's not forget the labor market and what that bodes for the consumer, which is still 2/3 of the economy. So though we think that a recovery is taking shape, we well recognize that there is a lot of risk, and those risks are disproportionate. It has a different impact on company dependent on size, balance sheet viability, and whether and for consumers, depending on what industry that consumer is in.
You mentioned unemployment, and obviously we get another report on Friday. The unemployment rate is predicted by economists in our survey to go below, get this, 10%, so 9.8% with the change in non-farm payrolls expected to be 1.39 million. I mean, it would be good if that were to happen, but it's going to be a long time before we're seeing the kind of unemployment rates that we had seen pre-pandemic, Nela. How does everybody manage?
I think everyone is experiencing this economy differently. We were going to celebrate that number, I think, in the markets if we do see the tick down under 10%. But let's not forget, this is extremely high and far cry from the 50-year low. And even as the markets have seen a new high, the economy that underpins that high is vastly different than we saw in February. Instead of a 50-year low, we're looking at an unemployment rate that's it's at highs that we've seen in the worst of recessions, and it's going to be a longer slog. So your question, how does everyone manage? Well, one focal point has been another round of stimulus in the CARES package. That would be the 5th round to those vulnerable households, businesses, and now we have to include states and municipalities that are being challenged by lost revenue. Whether we see that stimulus could make all the difference in whether or not this recovery is sustainable in the second half of the year.
So the Fed, has talked quite a lot now about letting inflation run above 2%. Nela, when do we see inflation? I mean, we weren't even, well, it was a whole different financial setup, I guess, pre-pandemic. But now, when do you see inflation getting above 2%?
Lonnie, I really don't see it, but I understand why the Fed wants to put our focal point there. I mean, if you think about where we are in terms of near zero interest rates, the Fed needs to make whatever policy move it can make given that it's constrained, as potent as possible. And the fear is if inflation drags below that 2% target, that expectations will be for lower and lower inflation, as will interest rates, which will follow those expectations, which will even constrain even further the Fed's ability to stimulate the economy. So this is really about making the Fed's very constrained moves as potent in the economy as possible by trying to tick up inflation expectations over the long term. And you saw the bond market, at least initially, respond to that attempt. So it's a modest change because it's still a 2% target, but it is a change that focuses on raising everyone's expectations that inflation could actually reoccur. And then the challenge is how do we do that without a massive credit stimulus? The Fed can keep rates low, can't make banks lend, and that's what you're going to need to see in terms of inflation.